Welcome to Trading Nation. I'm Mike Santoli. Walt Disney reporting quarterly earnings after the bell on Thursday. Our next guest says there are three things you have to watch. Tuna Amobi is director and senior equity analyst with CFRA. Tuna, good to see you. Let's get right to it. What are those things that investors really ought to try and learn from tonight's report?
Sure. So the first thing, Michael, is always going to be any update on the integration of the Fox assets. We know they just got the European Union approval, and we know that integration planning is already in process. So any word on where they are related to that would be quite helpful. The other issue is a direct-to-consumer strategy, right? So ESPN Plus launched last spring. Investors are waiting for any more clarity on potential timing of the launch of the Disney-branded offering in 2019. And lastly, I might also add any indication of the priorities, investment and capital allocation priorities before and after the close of the Disney transaction and the Disney-Fox transaction. We know that they are going to be getting some significant proceeds from the divestiture of the Sky minority stake, as well as the potential divestiture of the regional sports network. So there's ample proceeds, and some clarity on that will be quite helpful.
And when it comes to the direct-to-consumer strategy, what do you think we might hope to find out? I mean, is it going to be something about pricing or the exact timing of a launch for this kind of a product? Or I guess also just exactly what content might be included?
All of those things that you mentioned would be very helpful to learn more about the pricing as well as the potential timing. Now, those are two very big, important components of that strategy. As far as the content, I think there's a little bit more clarity in terms of the content that is going to be at launch. A lot of that, some of the content is already encumbered with some of the rights, but given the kind of visibility we have in terms of the slate for the studio for 2019, which is going to be the first year that content, the current releases, are going to be available on that platform. So I think the content is quite pretty much clear-cut at this point. The pricing and all the other things would be quite interesting to learn more about that.
And at this stage, with all the focus on the Fox transaction and the direct-to-consumer strategy, are investors no longer so fixated on things like cable subscription losses, or do you think there's a potential for a little bit of a surprise on that front at all?
I think that's a great question. I think there's always going to be, a lot of attention paid to, the attrition in the kind of the expanded basic bundle, as you alluded to. We've seen that in some of the companies that have reported already. That secular trend continues. But I think more importantly, Michael, is how much does the, the increase in the over-the-top, the so-called digital bundles are going to offset that. I think that's going to be the key. And we're seeing more and more of these kind of traditional losses being offset by the growth in the digital bundles. And I think that's one thing that was evident to us when Disney reported last quarter. Now, they don't break out the ESPN Plus, subscriber gains, but I think the traction, the qualitative commentaries in that area show us that the service seems to be off to a very, very good start.
Now, the stock has had a pretty good year. It's outperforming so far, both, I guess, the overall media group and the market. What is your stance on the stock right now? Where do you think it can get to?
So we have a 12-month target price of $130. We've seen a little bit of, making up some ground in recent weeks. But over the last 2 years, I think, the stock has been somewhat trading sideways. We think Disney deserves a premium based on the current target price that we have, anywhere from 15 to 20% over its peers, not only because it's a kind of a pure content engine, but also because we think the Fox transaction is going to place the company in a very unique situation as it launches its own direct-to-consumer strategy. Look at the content slate. It's kind of locked and loaded, going forward with Marvel, Disney and Lucasfilm and all the other Pixar. So I think there's really no company that's as situated as Disney to take advantage of these secular changes from traditional to direct to consumer. And I think that's where Netflix is going to be looking over its shoulder.
Yeah. All right, well, we'll see if those numbers give the market any cause to rebuild that valuation premium. Tuna Amobi, CFRA, thank you very much for joining us today.
Thanks, Michael.
And thank you for watching Trading Nation. I'm Mike Santoli. We'll see you next time.